Hey, what's going on YouTube? And welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Lux Algo. Lux Algo has some of the best trading indicators and AI agent for backtesting, used by over 15,000 traders, including myself. And I've covered many of their premium indicators in the past on this channel. And right now, if you sign up by using my link in the description below, you can get up to 20% off these premium indicators. Keep in mind, you can try them 30 days risk-free. So go ahead and check out Lux Algo. I'll put a link to them in the description below. Also, make sure to check out the Discord, completely free to join. I'll put a link to it in the description below as well. We just hit 7,000 members in here, so thank you. Now, earnings season is back. So let's quickly take a look here at the most anticipated earnings for the upcoming week. So here in the Discord, we do have this resources section on the left. Under this section, there is an earnings calendar channel. So every single week here, we post the most anticipated earnings for the upcoming week. So let's take a look here. So as you can see, earnings season is back. We have, of course, banks announcing earnings here next week. We also have big companies like Netflix, for example, announcing earnings. So earnings season is back. And because of that, today I wanted to talk about trading options for earnings. More specifically, I want to talk about a strategy potentially better than buying calls or buying puts for earnings. Now, for today's video, I'm going to be using ticker symbol ASML. And keep in mind, this stock has earnings, as we can see here, on Wednesday before the market opens. So I'm using this stock to give this a little bit more of a realistic tone. But again, everything I'm showing you here today is just an example. So don't copy any of these trades. I'm just showing you here as an example these different strategies that we're going to talk about here. So again, let's say I wanted to buy a call on this stock for earnings. So what would we do? We would go into the options here for ASML. And we want to make sure that we're on buy and that we're on calls here. So let's say I wanted to buy a call on this stock at, let's say, the 802.50 strike price. So under the strike price column here is 802.50. So let's say I wanted to buy this call here. So remember, buying a call gives you the right, but not the obligation, to purchase 100 shares of the stock at the strike price you selected any time before the expiration date. That's going to be if you exercise your option. Now, you can also, of course, just sell to close the option you bought as well. So that just kind of depends on your situation, but that's the definition of buying a call. Now, remember, buying a call is a bullish strategy, which means we generally want the price of the stock to go up here. When we buy a call, we're going to enter for a debit. So if we go here, you'll see, right, estimated cost or debit, $2,450 for this example. It's a bullish strategy. We're entering for a debit. We want the price of the stock to go up here. And remember, the debit that we pay here, that's going to be our max loss. So if we go down here, we can see our max loss is going to be equal to the debit we pay to enter here. So with that being said, what I want to do here next is I want to go over to option strat to visualize this trade here very quickly. So let's go over to option strat. I'll put a link to option strat in the description below. Really great options visualization tool. So if we go to build here, and notice under build, under basic here, there's long call or long put. So let's go to long call. And let's go to, again, we're using ASML for today's example. Expiration date, we left that as July 18th. And then we said, let's say we wanted to buy a call for earnings at the 802.50 strike here. And again, earnings is going to be Tuesday after the market closes. So let's say we come in here and, we're trying to see kind of what our profit or loss might be here, depending on the share price, depending on the date here. This is what this allows us to do. And so remember, when we bought this call, we're entering for a debit. That debit is also going to be your max loss. Max profit is infinite to the upside. If you have the premium version of option strat, you can see what the chance of profit is according to them, and we have our break even here. So here again, we have kind of what our profit or loss might be depending on the share price, depending on the date here. Now, here's what I want to actually talk about here today. So notice at the bottom right here, there is this slider here, implied volatility that says 55%. So we'll get into what that means here. But take a look here at what happens when we modify this slider here. So for example, take a look, again, earnings is Tuesday after the market closes. So let's say you come in here and you're looking to hold through earnings. You want to sell sometime Wednesday morning. Let's say that's your goal. So you come in here, you look under Wednesday at 8:30 a.m. when the market opens. And for example, you look here and you say, okay, if ASML is at 8:20 after earnings, according to option strat, this says I would be up $21. That's what this says here. But take a look at what happens when I modify the slider, and I'm going to actually decrease implied volatility here. And I'm going to be a little bit, I'm going to exaggerate here a little bit, just again, to get the point across here. Let's say this goes from 55 to 20% here. So I'm going to go to 20 here. So now let's take a look here. On Wednesday at 8:20, look at what this says now here. This actually says now that instead of being up $20, you would be down $623. And you probably noticed, right? A lot of this got really red when I did that. So the question is, what's going on? Why did that happen? Again, like we already saw here, right? It has to do something with implied volatility, or IV. So implied volatility is a measure of how much the market believes the price of a stock will move in the future. The thing is, during earnings, right before earnings, there is a lot of uncertainty and or risk around what will happen. Because of that, implied volatility will generally rise into earnings. However, once earnings is released, that uncertainty is gone because now we know what happened. And so what happens is you see what I just showed you here, what is known as IV crush, a sudden drop in implied volatility. And the thing about implied volatility is that it affects the pricing of an option. As you saw here, right? We were up $20. IV drops a ton. Now we're down $623. How does IV affect options? Remember, options have what are known as Greeks. So if I open this option, there is this Greek section. One of those Greeks is called Vega. Vega tells me how much the value of an option will increase or decrease with a 1% increase or decrease in implied volatility. And so the thing about buying calls or buying puts is that if IV, implied volatility, goes down, then that negatively affects the price of the option. However, if you're selling options instead and IV goes down, that positively affects the value or the price of an option. So, with that being said, now that we know all of that here is a potential alternative. So what I'm going to do here now is I'm going to switch over to puts here. So now we're on puts, and again, I'm just going to leave the expiration date as it is. So now what I'm going to do here is first determine what price you believe the stock will be above at expiration. So again, right, if we're looking to buy a call, that means we're bullish. That means you think the price of the stock will go up. So what price do you think the stock will be above at expiration? Let's say I think it's going to be above $825. Again, I'm just making random numbers up here. Okay, so let's say I think it's going to be above $825 at expiration. So what I would do here first is I would start by selling a put at that strike. So here's the strike, the 825 strike. I would start by selling this put here. Then I'm going to switch over to buy here. Now I want to buy a put with a lower strike. So let's say the strike, let's say 810. I'm going to select the 810 strike here. So I'm going to buy a put at the 810 strike. Now, as you can see, this is called a put credit spread here. So we're going to be receiving a credit here. So we're selling a credit spread. And remember what we mentioned a little bit ago. When you think IV is going to drop, you want to be a net seller. You don't want to be a net buyer. So here we're selling a credit spread. Because we're selling a spread, we're going to be receiving a credit here. Now, when you receive a credit here for selling a spread, that means you also have to put up collateral here. So that's how a put credit spread works here. Now let's go over to option strat and take a look at this now here. So let's go to a new tab here in option strat. Let's go to build, and again, let's just start with a regular put here. So let's go over to ASML again here. And again, first thing we did was we said, okay, if we're bullish, what price do we believe the stock will be above at expiration? Let's just say, again, we said 825, just as an example here. And then we said, okay, so we're selling a put there. Now we also want to buy a put with a lower strike. So I'm going to go ahead and add buy put here. And I say, let's just buy the put at the 810 strike. So you can see this is a bull put spread. So if we take a look here, this is still a bullish strategy here. But for this one, we'd enter for a credit. And that means we have to put up collateral. And then we have our max loss, our max profit, chance of profit, and our break even here. And so, again, this is still a bullish strategy. And for us to make our max profit, by the way, with this strategy, at expiration, we would want the share price to be above the strike of the put we sold. So if at expiration, this stock is at 825 or higher, that's where we would make our max profit of 830, as you can see here. Okay. Now, let's take a look here now at what we're actually talking about, which is IV Crush. So let's take a look here now. So we have our IV here, again, our IV slider. So take a look here. Again, earnings is Tuesday after the market closes. So let's say you're looking here, and let's say, let's just take at 8:23 here as an example. So July 16th, so Wednesday at 8:30 a.m. Let's say you wake up, and according to this, right, if you wake up, you'd be up 214 if ASML was at 8:23. So now let's take a look at what happens, again, if we see that IV crush. Let me know in the comment section below what you think will happen here before I show you. So now let's go ahead and move that slider down to, again, around 20%. So keep an eye here. So I'm going to go to 20% now. Now let's go back. Now take a look at that. Now you would actually be up $341 here. So even though we see IV crush, IV went down a lot, our profit actually went up here. Versus, remember, when we bought a call, we saw that we went from being up $20 to now being down $600. Again, this is because here we are a net seller of options. When you sell options, you want IV to go down. That's good for you. But when you buy options, you don't want IV to go down. That's going to hurt you here. So that's why here we can see, right, if IV is a little bit higher, if it's at 54% where it's at right now, you know, and if it stayed there, you'd only be up $214. But when IV goes down, you can see it's actually increasing here. And so if you think, right, if you're going to play earnings and you think there's going to be a massive IV crush, this could be a potential solution to that. Now, for buying puts, the corresponding strategy to that would be a call credit spread, or a bear call spread. So if we take a look here, right, bear call spread. Right now we're doing a bull put spread, but we're talking about buying puts. Again, all the concepts are the same, but the corresponding strategy would be a bear call spread there. You want to be a net seller of options to avoid that IV crush. So anyways, if you have any questions, feel free to leave them in the comment section below. Check out the Discord, link to that in the description below. Hope you enjoyed the video. Let me know what you guys think. I'll see you guys next time.